NIO's stock price has fallen to its lowest point in the past 3 years, currently trading at $9 per share, which is only 2/3 of Li Auto's market cap. Despite this, we believe that now is a perfect time to buy the dip in NIO. While investors may be overly focused on Li Auto's short-term delivery numbers, they may be underestimating the difficulties that Li Auto will face in transitioning from hybrid electric vehicles to pure electric vehicles. Additionally, we believe that the market has yet to fully appreciate the potential impact of NIO's battery swapping station on its vehicle sales. As consumers become more aware of the convenience offered by the battery swapping system, we anticipate a significant increase in demand for NIO's vehicles. Investors may be overlooking the network effect or Metcalfe's law that will eventually drive growth for NIO. Although the large capital expenditures associated with the construction of battery swapping station may seem daunting, we believe that the tipping point for NIO is approaching and that investors may be missing out on significant potential gains. NIO, the Chinese electric vehicle manufacturer, recently released their financial report for the fourth quarter and full year of 2022. The report revealed impressive revenue growth, with the company achieving 16 billion yuan in Q4 2022, a 62.2% year-on-year increase from the same period in 2021. The quarter's car sales revenue was 14.759 billion yuan, up 60.2% from the previous year. Despite this strong revenue growth, NIO's net loss attributable to shareholders increased by 168.3% to 5.8471 billion yuan. The gross margin for the quarter was 6.8%, a significant decrease from 20.9% in Q4 2021. This drop was attributed to inventory provisions related to the company's existing ES8, ES6, and EC6 models, as well as accelerated depreciation of production facilities and losses from purchase commitments. However, NIO still managed to deliver an impressive 40,052 vehicles in Q4 2022, representing a year-on-year increase of 60%. NIO is currently in a transition period for its product platform, but after launching 5 new models on the NT2 platform this year, the company is expected to have a stronger product cycle. NIO's products can be divided into 3 categories. The first is the main sales contributor, including the ET5, ES6, and ET5 Hunter Edition, with a target monthly sales volume of 20,000 units. The second includes the ET7, ES7, and ES8, with a target monthly sales volume of 10,000 units. The third includes the EC7 and EC6, with a target monthly sales volume of 1,000 to 2,000 units. Altogether, these product combinations are expected to support NIO's monthly sales of over 30,000 units. NIO's product strategy covers 80% of the main sales models in the segmented market of Benz, BMW, and Audi, and has the potential to compete for more high-end market share. According to the latest data, NIO's ET5 surpassed BMW 3 Series to rank third in China's high-end midsize car sales list in January 2023. While some investment banks are optimistic about NIO's profit potential, achieving profitability may take longer due to the company's high expenses on R&D, battery swapping infrastructure, self-developed batteries, and other capex investments. Although NIO's Q4 gross margin was 3.9% and is expected to be around 10% for 2022, we believe that NIO may require a best-selling mass-market vehicle similar to Tesla's Model 3 to achieve economies of scale, reduce procurement costs, and increase gross margins. The Chinese market for new energy vehicles priced between 100,000 and 200,000 yuan has been growing rapidly, and NIO could potentially benefit from this trend by producing a mass-market vehicle under a sub-brand, such as the codenamed Alps second brand. In the long term, if NIO can achieve vertical integration and maintain a gross margin of 20 to 30%, combined with the growth potential of its battery-as-a-service and software systems, the company has a good chance of succeeding in the market. However, the question is, how long is long-term in the context of NIO's strategy? It's worth noting that NIO's growth has been impressive, with annual deliveries increasing from 11,348 in 2018 to a projected 240,000 vehicles in 2023. In order to achieve its NT 2.0 platform goals, NIO must continue to aggressively expand its infrastructure, despite challenges such as supply chain disruptions and market volatility. Interestingly, NIO's initial push in 2023 will focus on building out its battery swap network, with plans to add 1,000 new stations by the end of the year, bringing the total number to 2,300. According to NIO CEO William Li, these new stations will be strategically located in both highway service areas and urban centers, with a focus on expanding the network to smaller cities. Li believes that this infrastructure is critical for NIO's expansion into lower-tier markets, and that it will be more important than traditional brick-and-mortar stores. For NIO, its battery swap network is more than just a service touchpoint. It also serves as a means of securing a competitive advantage by controlling access to high-capacity power grids in key urban areas, with plans to build over 1,700 battery swap stations in China by the end of 2023. NIO is betting big on this strategy. However, as NIO's user base continues to expand, there are concerns about whether the company's infrastructure can support larger-scale operations. Additionally, with plans to launch a second brand that will also utilize the battery swap system, there may be challenges in managing wait times and resources for users in different price ranges. These issues will need to be addressed as NIO continues to grow and expand its infrastructure. In conclusion, the new energy vehicle market in 2023 will continue to face both challenges and opportunities, as factors such as the disappearance of government subsidies and price wars accelerate the elimination of companies without core competitiveness, while also presenting opportunities for those who are prepared. CEO William Li has set a delivery target for NIO in 2023 to double the volume compared to the previous year. Additionally, if raw material prices continue to decline at the expected rate, the NIO brand is expected to break even in the fourth quarter of this year. With the three major growth drivers, NIO, which has stockpiled grain, is fully committed to an upward trajectory. In summary, NIO is poised to capitalize on the increasing penetration of new energy vehicles in China's auto market, and with its focus on vertical integration, expanding its service network, and offering innovative technologies, NIO is well positioned for future growth.